Well, welcome to today's FT Forum event. I'm Chris Giles. I'm the economics editor of the Financial Times, and it's my great pleasure today to be talking about the global economic outlook in 2022 with Sir Howard Davies, who currently chairs the NatWest Group. Now, Howard has a very distinguished career, ranging from being an advisor to Nigel Lawson in the Treasury in the 1980s, to the head of the CBI, Deputy Governor of the Bank of England, Executive Chair of the Financial Services Authority, and Director of the London School of Economics. And among other things, I'm sure he'd like me to mention that in May, he's got a new book coming out about the UK Chancellors. And so I'm sure that's going to be a very good read. Now, we're talking today about the global economy, what it's likely to look like in 2022. I think if we look at financial markets, we can see that they were extremely confident in 2021 that all was going well. And come the 1st of January, they've suddenly become very nervous. The IMF this week has talked about multiple challenges in the global outlook, and the World Bank has fears of a two-speed recovery. Howard, how do you see the year ahead?
As you say, the IMF earlier this week said that they expected world economic growth to be somewhat lower than before, and in particular, driven by supply constraints in the US especially. And so, of course, about 2.5 days later, the US produced its latest GDP numbers, which were much stronger than expected. So the poor old IMF forecasters look as though they've got egg on their face once again. But I've got to say that over the 12-month period, I think the IMF will probably turn out to be correct. If you look at the two big economies, the US and China, well, in the US, there are serious supply constraints, and they are feeding through into inflation. The US economy ought to be doing pretty well because interest rates, real interest rates are astonishingly negative in the US at the moment. Perhaps more negative than any time in history. And so it's not a surprise that the economy is moving ahead, but clearly the Fed is going to have to do something about it, and probably more than the market is expecting. If you look at what the Fed is saying about what they plan to do on their dot plot, it's actually a larger increase in interest rates than the market is currently telling us they expect in the form of if you look at the yield curve. So in the US, it looks as if there's a negative surprise on monetary policy coming along. And I think the likelihood is that there will be a slowing US economy. In China, it's the opposite position on monetary policy, because the financial conditions in China are actually loosening. And if you look at these charts that have loosening and tightening combination of exchange rates and interest rates, etc., Chinese are loosening monetary policy in order to attempt to offset two things. One is the negative impact of their very aggressive zero COVID policy, which is having quite severe constraints imposing quite severe constraints on the economy. And secondly, that the property market in China has fallen out of bed, and the building is slowing down, house prices are falling, and the Chinese are attempting to sort of offset that by actually loosening monetary policy. But I still think that the chances are that the Chinese economy will slow, and that we're looking at 4 to 5% growth in China over the next year, which of course we'd be delighted to have in the UK, but is rather less than the Chinese have been used to. So if you look at those two big growth motors, I think they will both be slowing down. And so I think the IMF's general direction of change, which is that growth will not be quite as good as they thought it would be, is probably the central guess about what's going to happen in the next 12 months.
And that's entirely in line with how the IMF were thinking, because their downgrade was dominated by both the US and by China, which of course are in the world economy. They don't dominate the world economy. They're not half of the world economy, but they're very, very large players, and both of them of a similar size now, and it's no longer the case, is it, that if the US sneezes, the rest of the world gets a cold, because we have two big players in the global economy.
But if both sneeze at the same time,
exactly, if they both get COVID, which it clearly is not supposed to get at all in China. How do you see the US versus Europe in terms of, not just in terms of, we know the US is, as you say, not likely to grow as quickly as it hopes, and that's one of the big changes at the start of this year. How's it done relative to European economies and the UK?
There's some interesting research looking at the relationship in the COVID crisis between, if you like, deaths and the economy. I mean, this seems like a pretty brutal kind of calculation, but deaths really in relation to population as a proxy for the degree to which the economy has been closed down, and then the economic growth is the reciprocal of that, if you like. And if you look at, say, France and Germany versus the US, you can see a kind of logical relationship that the US have actually had more deaths, but the economy has been stronger. The French have had, relatively speaking, fewer, and the economy has been weaker, reflecting this sort of intensity of the lockdowns. Unfortunately, just as a parenthesis about the UK, we have had more deaths and a weaker economy. So there's a line you can draw, and some French government researchers have drawn this, of the sort of deaths versus the economy, if you like. And the French and the US are roughly on the same line. They've just chosen to be in a different place on it. But we are off the line. I mean, more deaths and an overall weaker economy, taking the 2 years together, of course. And if you look at why that's happened, well, it is partly because of the COVID measures being less severe, but also, of course, the US have had very dramatic fiscal interventions, have spent an awful lot of money and spent it very directly in the form of checks to individual households, which have been spent pretty quickly. And so it's not a surprise that the US has done very well. Now, Europe has, of course, agreed the next generation 750 billion euros, etc., but it's still not been spent, really. I mean, most of it's not been spent. Now, in the longer run, you may say, well, this will deliver more value if it's spent wisely, and particularly if it's spent on a green recovery. Then maybe the European fiscal intervention as a response to COVID will in the long run be more effective than the US one, which has been largely fueled consumer spending. But for the moment, you can see that the US economy is doing better, and has been growing pretty rapidly. But also, as I said in answer to your first question, partly because it's got extremely low negative real interest rates, which are lower than in Europe because of the high inflation.
And I will come back to inflation and interest rates in a second. But when we speak about Europe, is it right to be speaking about the Eurozone as a single economy, or has the last couple of years actually shown us it's still really rather diverse, with big differences between different parts of the region?
Yeah, one of the wisest commentators on the Eurozone, Henry Genderlein, who sadly died recently, has summarized the position in the last few years as being that he said the Eurozone, the ECB has made a very, very sensible monetary policy for a country that doesn't exist. And the problem is that at the moment you've got strong inflationary pressures in Germany, less extent in France, but still some. But you've still got economies in Southern Europe which are badly affected. And we know from the start of the Eurozone that there's been a competitiveness problem, competitiveness of the southern European countries deteriorated in the first 10 to 15 years of the Eurozone's existence because they had cost pressures they weren't able to offset. They weren't able to match the German productivity performance. So there's been a two-speed Eurozone ever since the beginning, in fact, with the performance Italy and Germany, a comparison being quite stark. But unfortunately, COVID has accentuated that because the biggest hit from COVID has been on industries which are relatively more important in southern European countries than in the north. The obvious one being hospitality, tourism, travel, etc., which is a much larger part of the Italian and Spanish and Portuguese and Greek economies than it is of the German economy. And so the nature of the COVID hit to the economy has accentuated what was already a problem of a two-tier Eurozone, or two-speed, should I say, Eurozone economy. And that, I think, is a really big dilemma for the ECB, and I think explains why the ECB is still very reluctant to suggest that it's going to do much in the way of tightening. I mean, reducing a bit of QE, but interest rate rises are still quite a way down the track as far as the ECB is concerned, because they are very anxious about not putting up rates at a time when some of these southern European economies are really on their back still.
Do you see, when you think about the southern European economies, do you see that as, and I suppose it applies to the UK and the UK European versus America, do you see that as recovery delayed, or that's a permanent hit to their economies that will be with them for a long time, if not forever?
Yeah, that raises the sort of, that's the general kind of scarring question as to, what will be the long-term consequence of the of COVID. And I think it is probably true that there will be more long-term scarring of the parts of the economy which they are strongest in. I mean, it's hard to see tourism coming right back to where it was, as long as there are any constraints on international travel. I think people's 2-week holiday will survive. It will be worth getting the tests and getting yourself sorted out to do that. But a lot of the sort of shorter trips in and out, I think that will be much more difficult. It's quite time consuming and costly. It adds costs, etc. So I suspect that there will be slightly more scarring in those economies than in the German economy, because we've seen that people have moved towards hardware from software, if you like. How long that can continue, I'm not quite sure. But particularly also, if we have a green recovery where there's a kind of retooling of our economy, I mean, most obviously seen in the car industry, it's going to be the countries that are strongest in the car industry that are going to be kept working hard to replace current gas guzzlers with electric cars. And that's going to be more, I think, in Germany and some of the other, German Deutschmark zone countries, as we used to think of them, than it will be in the south. So, yeah, I fear that the scarring will be longer and deeper in the south than in the north. I mean, those are shorthand terms.
Yeah, and just bringing it back to home, bringing it back to the UK, how much do you see the long-term damage? Because this clearly matters for all the things we care about in politics, whether you need to have tax increases, the living standards of the population in the longer term rather than just in the immediate term. How much of a sort of permanent damage do you think the pandemic is going to?
This is tricky, and there's a remarkable variation in estimates of this. If you look at where we are now, right at the end of 2021, the economy roughly in November, I think, was pretty much exactly where it had been 2 years before. And December looks as though it's going to be slightly weaker than perhaps in December the previous year. But nonetheless, let's say we're back to where we were, and therefore we've lost 2 years of growth. Growth rate was not particularly strong. The trend growth rate, I think, generously might have been 1.5% or so. So you can say we've lost 3% unless we catch it up. Now, I don't know of a particularly good reason why we should catch it up. Now, I mean, there is still some consumer saving that could be spent, which might bolster consumer expenditure for a while. But investment has been very weak. And so it's a little bit hard to see why we come out of this with a trend growth rate that is faster than the one we had when we went in. So that would say, well, maybe we've lost 3%. And that was the OBR estimate until recently, and is still the IMF's estimate of the impact on the UK economy. There are some suggestions, however, that they may be moderating that a bit, because there have been some effects. I mean, productivity has been improving a bit, partly because of a rebalancing of the economy away from low productivity areas where productivity increases are hard to achieve, like hospitality sector. It's not, productivity doesn't grow very much, into more manufacturing areas where productivity growth is more rapid. So productivity, there's a mix effect, which may be suggesting a slightly higher growth. But I personally find it quite difficult to see why we should end up with a trend growth rate much higher than we had when we went in. Perhaps for a short period of time, maybe there'll still be a bit of pickup in 22 as people spend down these savings. But looking at 23 and 24, I can't see why we go back to anything bigger, because investment has just been weak. I can't see it. So somewhere I would say between 2 and 3% is the loss, the absolute loss to the economy, which we're unlikely to recoup. So it could be the bottom end of that range, could be the top end of that range, not quite sure. And at the moment, people are, there are varying views about it. But it does seem to me that's in the sort of territory. So not chronic, I mean, not an absolutely massive long-term impact, but nonetheless unhelpful from a public spending point of view. Now, you might say, well, what about employment? Unemployment is very low, and that undoubtedly has helped. The labour market has performed better than expected, even the ending of the furlough scheme. But when you look at the labour market, what you can see is that participation rates, particularly for older workers, have fallen quite sharply. And it looks as though many of those people are not likely to come back to the workforce. If you lose your job at 64, 65, and there's a couple of years when you retreat from the labour market, what's the chance that you're going to come back in? Not great. So I suspect that we have lost some labour force as a result of population, of lower participation rates. Population growth is lower. People are having fewer children. And European migration, of course, is considerably lower and is unlikely to be compensated by non-European immigration fully. So we're probably going to have a slower growing workforce for all of those reasons, so that the current unemployment number is not really, in my view, telling you that you've got an economy about to race away. It's telling you that you've had a supply problem in the labour force, which has left you in a reasonable position on an absolute unemployment level, but doesn't suggest that there's a dynamic in the economy that's going to push us ahead more rapidly.
Now, we've been talking about the central forecast, which has not been particularly cheery, I've got to say, and about where we think we might well end up in the medium term, which is not so bad, because normal recessions often have scarring of about 4%, and the global financial crisis was about 15 to 20%. So better than that, but still not great. We need to talk about risks. We've got 120 odd thousand Russian troops on the Belarusian or Ukrainian border, either in Russia or Belarus. That clearly is going to be a big downside risk for this year. Do you see that as the big thing that we need to worry about? What other things are on your mind?
Well, that is, I think, a risk. And I think it'll have, if there is a conflict, then that's going to be quite damaging for confidence. But even if there isn't an actual hot war, the impact on energy prices looks as if it could be quite enduring. And it's arrived at a time when Germany in particular is very heavily dependent on gas from Russia. It's quite difficult to replace that in short order. In fact, they're going to need more of it because of their decision to close the nuclear plants, which looks increasingly curious in retrospect. And so I think the impact of that on energy prices, which also will be pretty negative for the world economy, is the channel from that risk, is how that risk gets crystallized, I would say. I mean, I don't want to speculate on the guess about what would happen if we actually had a real hot war in Europe, but I suspect we'd be talking about other things if that happened. But so assuming that this tension remains and there's some sort of messy outcome, then I think the likelihood is that the consequence will be on higher energy prices. So I think that's one. A second is that interest rates may well need to rise more. As I said a few minutes ago, at the moment, the market is expecting a modest rise in interest rates. And already the Fed, the FOMC people are on their plot of what they expect. It looks as if they're expecting higher increases. And one of the things that I've found over the years is it's quite surprising how things that you think are in the price, so to speak, when they actually happen, people go, oh God, rates have gone up. And that somehow, even though you and I can talk endlessly about inflation, and there can't be anybody around in business who doesn't know that inflation's on the rise and therefore that interest rates will probably rise, when it actually happens, you can get some strange disruptions, and you discover that there are people who are over leveraged and overexposed, and that suddenly things happen that you don't really expect. So I think that's a second one, that whenever the interest rate cycle turns, it turns out that there are some people who are surprised and overexposed, and there are casualties. So that's a second one. If it weren't for the Russian thing, we'd probably still be talking about US-China tensions, which haven't gone away. That is still a downside risk, which is hard to foresee. And of course, within Europe, again, we've sort of relegated the tedious issues of the Northern Ireland Protocol and the general relationship between the UK and the rest of the Eurozone to a sort of sideshow for the time being, but they remain there. And we've got cues in the A20 to prove it. There's still very difficult conditions on the border here. So there's all kinds of things that could go wrong, I think.
One thing that's clearly was the risk that people didn't see last year, or people until the middle of the year, was inflation. We need to talk about inflation. In the UK, 5.4%, 30-year high, 40-year high in the US, 30-year highs in Germany and France. What's happened? What's gone wrong? Is it just been something that no one could have foreseen, its energy prices, or is there something deeper at the root of all of this?
Well, the difficult thing I find about this is that for a number of years, it's been quite hard to explain why interest rates were so low. Why it was that even though the economy had recovered after the financial crisis, was growing sort of okay, that interest rates were still in negative territory and that there was an imbalance between savings and investment. That's, I suppose, the simplest answer as to why that was the case. But I think many people thought, well, can you really run an economy with negative real interest rates in the long run? Will that sort of work? And so in some way, I'm quite encouraged by the revival of inflation, because we may well be the trigger that gets us back into a slightly more sensible relationship between saving and investment, and a slightly more understandable constellation of interest rates. But I think, to get onto your specifics, I think that the central banks believed and kept saying until, I think, November, December, that this was transitory. Now, the Fed have now formally retired the word, as Jay Powell said. So we're probably, you and I should not be allowed to use it. But nonetheless, as historians economic historians, we can recall that they were saying that for quite some time. They were saying it was transitory. I think the problem with that is that what the central bank regards as transitory, and therefore they should look through it in setting their interest rate policy, the average consumer does not think of as transitory. They react to the inflation rate that they perceive when they spend. And if you look at inflation expectations are much higher among consumers in the US than they are among economists. I mean, the latest figures I saw, so that economists on average thought that inflation was going to be 3.7%, and consumers thought it was going to be 4.9%. And there was a massive spread, but that was the average. And a lot of people think it's going to be more because they say, well, look, we actually are spending more. I mean, you can say it's transitory, but I've actually had to fill up my car and it has cost me that much more. And so that seems to have fed through into expectations, inflation expectations, and more, I think, than the central banks were thinking it would. Somehow they'd convinced themselves that individual consumers would also look through this rise in rates and say, oh, well, that's just because of energy costs and there's nothing much they can do about it, so we'll just ignore it. That now seems to have got into embedded inflation expectations, so people really think that this is going to carry on. So I think the central banks have now got a big job to correct that. And therefore, that might mean that they have to do more on the interest rate adjustment in order to correct those inflation expectations. Because I suppose slightly old-fashioned maybe, but I still do believe that it works. This monetary policy works in large degree through expectations. And if you can persuade people that inflation is going to be at your target, that does a lot of the work for you. You have to do less in actual raising the cost of credit because people are still expecting inflation to come back down to 2. And I think that the central banks have lost control of inflation expectations. And I think that's going to have quite a consequence. And the outcome will be that they will have to do more to raise rates in order to get those inflation expectations down. Once you've lost control of them, it's harder work to get them back again. So that's a convoluted argument that leads me to think that we may end up with slightly more enduring inflation and a larger rise in interest rates in order to get it back under control.
We've still got interest rates extremely low here, 0.25%, the base rates, but mortgage rates are very, very low levels for people, for borrowers, and for companies borrowing equally low. Same in the Europe, same in the US. When you say central banks will need to do more, can you sort of be a bit more tangible about this and say sort of how much? Presumably you don't mean going back to the 5% interest rate in the UK that existed pre-financial crisis.
No, well, the Fed's dot plot suggests that they might get to 2.5% by the end of next year, which is more than the market's expecting. That's the sort of territory that I think is quite plausible. A bit less here, and probably a bit less again in the Eurozone.
And is it wise then, if you're trying to act rather than trying to physically take money out of people's pockets by making credit more expensive, is it better, and you want to act on expectations, does that suggest you want to go sort of quite hard quite quickly so that we might see a lot of action sooner rather than later?
Well, that would be my recommendation if I were part of the Monetary Policy Committee here now. But then I've been saying it since last July. So nobody's paying any attention. I doubt if they will now. But I do think it would make sense, and I think it's pretty clear that the bank should have acted a bit earlier than it did. I think they would have to do less if they had acted a bit earlier.
Yes, I think you can tell from how quiet they've been over the past month or so, compared with how noisy they were when they were doing nothing, that they really are thinking that they've got a problem on their hands now. So yeah.
Well, one of the difficulties in the Bank of England, I mean, to some extent true in the Fed, but less so, is that with all these individuals and the members of the Monetary Policy Committee, each of whom has to justify their position, and they all make speeches, and they all get hooked on a particular set of propositions about their view about inflation and interest rates. And then in order to sort of adjust the balance of argument on the Monetary Policy Committee, they each have to find different ways of getting off and making another speech and explaining why their views have changed, etc. So when you turn this tanker, it takes quite a long while to turn because the dynamic on the committee is a bit different because of all this, because of these individual voting and the individual accountability, which generally we think, is a good discipline and brings in broader views into the Bank of England, avoids kind of a group think. But actually, I think when you really need to change quickly, it's a disadvantage. If you just had a group of all Bank of England people and sat around and said, look, boys, the figures have changed, haven't they? So we're just going to change. And we'll all we don't each have individually to justify our views. We just collectively, we say we're moving. And I think we're seeing something of the disadvantage of a diverse and individually accountable Monetary Policy Committee, which therefore takes some time to go in a different direction.
So does that mean, you think, if we stay at home here, that come the spring, we might well be seeing not only big rises in energy prices, but also one, maybe two further interest rate rises and tax increases? So it's really the squeeze on household living standards is going to be pretty grim.
Yes, but I think it will probably be rather varied depending on the level of income and the sort of people. So if you're living entirely on pensions and unearned income, etc., you're not going to see any tax increases because it's not a tax increase; it's a national insurance increase, which doesn't apply to them. And also, of course, there will be quite a few people in the workforce who will be able to attract significant pay rises, and we can already see that happening. I mean, the market in some areas, particularly IT staff of one sort or another, is very strong. And so those people are not going to face real reductions, I don't think, because I think there are going to be quite significant pay rises in parts of the economy. So I think it's going to be quite differentiated, the impact on earnings. But net, you're right that on average, it looks as though real earnings are going to fall, which will sort of partly use up this accumulated savings, which we still have. There's still a lot more saving over the last 2 years, and people are going to have to dip into those savings to maintain their standard of living during a period when earnings will be negative, real earnings.
Yeah. Now I'm very shortly going to be opening this up to questions from you, the audience, so please keep putting them in. But before I do that, I just wanted to ask a couple of questions about your experience in the financial sector at the moment. What are you actually seeing on the ground? So first of all, what do you see in terms of companies and investment? What are the trends that you can tell us about?
Yeah. Well, unfortunately, investment intentions remain quite weak. And there was a change after the Brexit vote, actually, in investment, and investment in the UK has remained weak since then. The government, of course, have made big tax changes to incentivize companies to invest. And so I would assume that's had an impact, but it hasn't had a big enough impact to push investment back above trend. I mean, it's still below trend, the percentage that companies are investing in, below the long-term average. So without government action, it would have been worse, I'm sure, but it's still not great. If you look overall, then what you can see is that large companies have gone back to borrowing from the banking system. not all of it for investment, but for operations and efficiency improvements and things. But I mean, they look as if they've gone back into a position where their credit demands are reasonably understandable and are quite high. Whereas SMEs are still net repaying debt. Now, I'm always conscious of when you produce these generalizations, of course, you can find lots of SMEs who are booming along and etc. But on average, the SME sector is repaying debt, not on a massive scale, but it's repaying debt. And that, I suppose, is partly because of things like the bounce backs and the COVID recovery loans that the government pushed out. Quite a lot of companies took those because why not? You might need it. Many of them have restarted and discovered they don't need it, so they're paying those down. So some of that is, understandable. And in fact, we could see it at the bank that quite a lot of companies just took that money and put it back on deposit straight back with us. But that wasn't stupid, because you never know when you've got some free money on offer, and you never know whether there might be a liquidity squeeze. Because the last time we had a big crisis, the banks were squeezed for liquidity and couldn't lend. And so people taking it, drawing it down and putting it back on deposit was, as I say, looked odd, but it wasn't stupid, because at least they had access to it without having to come and ask us for it. But quite a lot of that is now being reversed. There people say, well, okay, we've gone back to normal trading. We don't need that. We aren't going to expand, actually. I don't have an investment need, so we repay it. So net, the SME sector is repaying debt.
And how is the banking sector, or the financial sector itself, in a world of high inflation, rising interest rates? Is that a good world for your new sector, or the sector you're currently in?
Yeah, well, I think that it's interesting that if you leave investment banks out of the picture for the moment, if you talk to bankers here or in Europe, or indeed the normal commercial banks in the US, the Citi and BAML and people like that, the position is all quite similar. And what we all did was we had to make large provisions in 2020 because the accounting standards require you to model the impact of recessions and produce a number for likely impairments. I say likely impairments because the number is actually not, almost by definition, it isn't what you expect, because you have to look at scenarios and you say, well, there's a third possibility that we come out of all of this. It's a nice V-shaped recession and we're back quite quickly to where we were. A second one, maybe, well, we go down and we bump along the bottom for a bit, then we recover. And then the third one is that, it's a nightmare and, we don't recover, we have an L. And therefore you factor, you say 1/3 this, 1/3 that, 1/3 the other, and you produce a number of what losses you'd make. Almost by definition, you explain that, you can't have those three things happen at the same time. So it's almost certain, it's certainly wrong. It's about the only thing you can say about it is it's wrong. But we all did that. And then, most commercial banks showed big losses in 2020. And then since the government support programs have been really quite effective in all places, the absolute losses have been much lower than these provisions would suggest. And so essentially banks have been writing back loans at slightly different rates in different places, but essentially that's what's been going on. And the banks survived all of that quite well because they were quite well capitalized on the way into this as a result of the recapitalization done after the global financial crisis. So this was a sort of big stress test of the banking systems, which sort of was almost designed, if you like, to answer the question, well, are they now better capitalized? Can they survive a sharp shock to the economy and still be able to provide credit and lend? And the answer was yes, that broadly they could. And one dog that hasn't barked during this crisis is the bank bailout dog. We haven't had that really.
Yeah, thankfully, because it was awful in 2008, 2009, wasn't it?
Oh yes. So there's no doubt that the painful recapitalization of the banks. If you look at RBS, our position is RBS now NatWest, but comparing RBS in 2007-8 with sort of NatWest today, the calculations have done slightly different way, but we had somewhere at the time in 2008, somewhere between 2 and 4% of capital, of core tier one capital. And we've currently got 18, a bit more. And now we've actually got more than we really need to do with the complications of the government's ownership and selling down, etc. But still, our target is to have 13 to 14%. So still 3 to 4 times what we had before. So this is painful. It's not great for bank returns, of course, because that's dead money that you have to hold in the Bank of England, etc., with negative rates, or in some cases, or at least 0 rate. But the banking system survived quite well. Now, its profitability has been depressed because 0 interest rates are not great from a banking point of view. And therefore, if you look at a price to book, most European banks are trading at considerably below book value. Even the sort of decent ones that are not in any trouble, I would count us in that category, are trading at 0.7, 0.8% of book, which is, a peculiar position to be in for the long haul. So the market's saying you're safe. You're sort of, you're not going to fall.
You're not excited.
You're not going to earn much money when interest rates are very low.
Now, I'm going to go to the questions from our audience. There's quite a few have come in, and there's some interesting questions here. So the first one takes, again, asking for your view from what you know from your current position, but highly political. What impact is the political uncertainty over the future of Boris Johnson going to have on business confidence?
My feeling is that that it hasn't, curiously, had a massive impact on people. I mean, it's hard to put this quite in the way that doesn't make it sound sort of offensive, really. I used to struggle with this when I was at the CBI, but there are some dimensions of politics that most business people go, oh God, let them sort themselves out, and they don't really react to it in a massive way. They will read the papers just like everybody else, but it doesn't cause them to say, oh Christ, we ought to stop investing, we ought to stop this, we ought to stop that. They regard it as a kind of soap opera, which is going through an exciting phase, and probably it'll come out of it at some point. Now, I think where that could flip is if you started to see unwise and unreasonable and very political decisions being taken in economic areas in order to offset the threats of these, of cakes. And so, if, for example, the national insurance increase were abandoned, or if some, very aggressive things were done to try to cap energy prices, etc., then I think you might get people go, whoops, this political instability is actually feeding through into irrational economic decisions. And that would be quite damaging. And so, on the national insurance increase, I mean, I think you've written on this as well, don't think that national insurance was the ideal way of generating more money that you need for health and social care. I think it should have been done with taxes, but abandoning that would, I think, cause people to say, whoops, this suggests that the Treasury's, well-considered, voted through Parliament policy has now been changed in order to bolster, a particular regime. That would be, I think, the point at which it would sort of start to cause people concerns and start to affect economic decisions made in business. I think at the moment, it probably isn't doing that.
So you'd say they absolutely shouldn't change the national insurance. We have one question is, do you think they will?
Well, the interesting thing about it is that it doesn't, if you abandoned it, you don't do anything for pensioners, of course, who are quite influential in the Conservative Party because they're not actually going to be paying it.
No.
So, curiously, taking that off because of the odd way you've put the price on doesn't really do anything for the people who are probably most important to you in your constituency associations. I wouldn't be astonished if they deferred it. They possibly could do, although I think this notion that the Chancellor can kind of afford it and has headroom at a time when you've got debt to GDP of 96% and the prospect of rising interest rates and increasing debt servicing costs, this short-term adjustment in the borrowing profile doesn't seem to me to solve the problem. So I still hope they don't do it. It's possible that they will, but I think the price would be quite high for the reasons I've set out. That, the Treasury would have to think very hard about how it justified this, because it didn't justify it on the basis of just a short-term borrowing profile. It justified it on the basis that we were going to need to actually spend more money to get waiting lists down and to begin to rebuild the social care system in this country. And so, that's actual real spending. It's not just a sort of change in the borrowing profile. So I think it would be very difficult for them to do it. And I think the Treasury will fight quite hard to prevent that because it would be quite a difficult thing to explain why you've done it.
I mean, I think
whether it will happen, that then gets tied up in just how the politics of. My answer to that question is Sue Gray.
As is everything, and I think we don't have the answer to Sue Gray as we are currently speaking. No. Yeah, so let's look at another question, which is not something we can actually have a view on, which doesn't depend on immediate politics, but is incredibly important. So the question is, will GDP be affected in the medium to long term by climate change and by the emissions target reductions or the targets to reduce emissions?
Yeah. I think that it will to some extent. And whilst in the medium to long term, I am broadly speaking a buyer of the argument that there is a green transition that can be engineered, which is positive. I think I buy that argument, and that we don't necessarily have to all sit at home, dressed in thick woolies and sort of the energy utilization has to collapse. I think there is a way through this, but the disruption on the way could be quite considerable because there are, huge transition costs. And we find in dealing with companies that the biggest ones have got a plan and, they can probably afford it. And there will be more borrowing for a while, but they've got a plan. But there are a lot of people in the smaller and medium-sized enterprise who don't have a plan for transitioning, and where it will be, quite costly for them to devise one, and they'll probably do it too late, etc. So I think it'll be a bumpy road, is my view. Although, I don't think I would take the view that inevitably at the end of this transition, we end up with a smaller economy and a lower growth rate and everything else. I think there is a good outcome, but I think it'll be a bumpy road.
And just if I can ask a cheeky follow-up to this, you ran the Airports Commission in the last decade. Does how we're now thinking about the transition to net zero make you think again about things like the need for a third runway?
On the timing, yes, because the timing of the third runway proposal that we put forward was dependent on traffic growth forecasts, which have been torn up.
Yeah.
Now, then you say, well, what will happen to traffic forecasts? And I suspect that air traffic will come back, but probably it will be on a lower profile than it was before. I mean, we looked very hard at the time at things like, video conferencing, as we used to call it, as to, whether that would have an impact. But the technology had been available for quite a long time, and it hadn't on business travel. It had remarkably little impact on business travel. But this has been a shock to the system. And undoubtedly, this has changed people's attitude to business travel and also to tourism. So I suspect that the profile of demand will alter. So that will affect the need for additional runway capacity. As for whether you get eventually to have more runway capacity, I suspect you probably will in the end. I think that there will be less carbon emitting ways of flying planes, as this has given a huge boost to the search for jet fuel. Jet fuel is the most difficult thing to find another solution for other than oil. Nick Stern once said to me when I was talking to him about this work that the last barrel of oil we burned in a plane, he said, because it is the most difficult to produce high octane from seaweed or whatever. But I suspect that in the end, there will be more demand, and that the logic of where that space should be is at Heathrow. And one of the reasons for that in the new world of climate change world is that it is much more efficient to run a large hub system than it is for lots and lots of small point-to-point connections, which are difficult to make full all the time, and which are, therefore emit more. So we modeled looking at, whether you could expand regional airports and all of that. And our conclusion was that if you looked at it from a climate change perspective, which we did, that the most efficient from a carbon perspective way of organizing connectivity was through expanding Heathrow. So in the end, I think it will come back. I wouldn't want to change my conclusion on that, but the timing, of course, for the reasons I've explained, is clearly going to be different.
That's a very clear and important answer, I think. Our audience is very much focused on really big issues. So the next one is I'm going to hit you with another big issue, Brexit. What's been the cost of Brexit to the UK economy and the EU economy? Do you think, as we're talking now, 5.5 years after the vote, 2 years after the
UK 4%, EU not much.
Yeah,
the estimates on this have been remarkably consistent, actually, from a whole range of forecasters. If you exclude the sort of politically motivated at both ends of the spectrum, I should say, there are some who world will end at one end, and others who say no, we'll be able to compensate with, etc. But I think the broad consensus view, which is the OBR view, is that it'll have about a 4% impact on productivity and GDP over a period of, say, 5-6 years. Probably we've had about half of that already, and we've got another half of it to come. Now, there are still some imponderables because, of course, we don't really have a stable position yet with the Northern Ireland Protocol problem and the potential for retaliatory measures if we decide to trigger Article 16 or that. So there's still some quite big uncertainties. And we also haven't got a full adjustment to the way in which, the new rules work. But I haven't seen anything that produces a better rough estimate of the impact on the UK economy than that. And that's, of course, one of the problems the Chancellor's got in the overall spending profile as well. As for the EU, I think it's a bit lost in the wash, frankly. for the scale of their economy, and an average figure would be quite misleading. I think that Netherlands, Belgium, probably more even than northern France, because the Belgian trade with the UK and Dutch very high as a proportion of their total trade, and therefore I think that there are material effects there. But once you get to Austria, I mean, I don't think there's any effect at all.
Yeah. It is one of those remarkable constancies that you see in economic forecasts. We were talking right at the start about how much people got wrong, but so far, at least, there's been no reason to change those middle range forecasts of about 4, call it 3, call it 5, whatever. But that sort of longer term hit, and as you say, about half we think has already happened. So it's bad but not terrible in the medium term. Now we're going to move on to dinner party conversations. What impact do you expect to see on housing demand as mortgage repayments increase, as it were, with interest rates and housing energy bills increase? So people are interested in your house price.
There's an interesting paper produced by the PRA, Bank of England, this week, just yesterday actually, saying that debt service ratios are the most decisive thing on macroprudential policy and on the impact on the housing market, much more than changing loan to valuation rates and that kind of thing. So I would expect there to be an impact, but if you look at the likely profile of interest rates, and as you challenged me as to where I thought they might go. And as I say, if you say in the US, maybe 2.5, but I mean, here, maybe 1.5. I mean, still, for most people, given that there have been constraints on loan to valuation rates, and, the 105% Northern Rock mortgage is not a common thing in the market these days. And so the mortgages that have been issued in the last 10 years have not been in that racy territory at all. So the propensity for actual distress in the housing market and repossessions, if interest rates rise by 1.5% or so, I don't think is high. We would not expect a large number of people to actually be in real serious distress as a result of that, because there are not that many people who are on loan to valuation rates above 75%. And so, they've got equity. Whether house prices will fall a bit, I should think that's a lot. That would be logical. But would they fall enough to put a lot of people into negative equity and really therefore create a disruption in the housing market? Because that's when you get a disruption, when you get negative equity, you get repossessions, and then that pushes prices down further and more people in negative equity. You get that sort of nasty spiral, which we've had a couple of times. I don't see that coming on the kinds of interest rate forecasts that seem plausible. So I'm not losing sleep about that at the moment.
And presumably, after all the house price rises we've had in recent years and decades, that the equity level of the lending books must be pretty strong. It must be, if not at an all-time record, but there's quite a cushion to eat up before people get into stress.
Yes, but the average length of a mortgage is quite short. People have done a lot of remortgaging, now, and partly the low interest rates have stimulated people to do that, and they've taken on more debt, and they've spent more money on their extensions, and they've spent money on kitchens and stuff. So it's not as if you've kind of had a long period where the mortgage, where everybody had, as in the olden days when I got my first mortgage, it was 25 years variable rate and 2.5 times your salary. And, that was what it was. And therefore, if house prices rose, people floated off high debt ratios really quickly. But now that it's a much more dynamic market because people are, remortgaging constantly and adding a bit and stuff. So I don't think that the equity cushion has gone up that much. But because of the constraints by the regulators and also by the banks themselves, having seen the problems of 2008-9, even the newer stuff has not been issued at very high LTV rates.
Well, Howard, thank you ever so much. I think we're now sadly out of time. I think our whole audience will agree with me that we've had a really stimulating conversation. Well, you've given us a really stimulating conversation with very wide-ranging from the rather sort of maybe a little bit murky outlook for the global economy, big issues of climate change and Brexit, and even the parochial issues of our own house prices. So I just want to say to Howard, thank you ever so much for joining us this afternoon. It's been a real pleasure having the conversation with you. Thank you very much.
You're welcome. Thank you.